Welcome to the Slop Farm. Enjoy the video.
Have you ever wondered how interest rates are set, or where banks get the funds they lend out? That's the fascinating world of the money market. It's essentially a marketplace for very short-term borrowing and lending, typically for a year or less. This market plays a super important role in our daily lives, even if we don't always see it directly. It's where financial institutions, businesses, and even governments manage their immediate cash needs. To truly understand how this market works, we often use a simple graph. On the vertical axis, we measure the nominal interest rate, which is essentially the price of money. Then, on the horizontal axis, we have the quantity of money in the economy. This visual setup allows us to easily track the relationship between how much money is available and what it costs to borrow or use that money. It's a fundamental tool for economic analysis. So why do people, businesses, and governments demand money? We need it for everyday transactions, like buying groceries or paying bills. We also keep some aside for precautionary reasons, just in case of an emergency. Then there's speculative demand, where people hold money based on expected changes in interest rates. As interest rates fall, the quantity of money demanded generally increases. This creates a downward-sloping demand curve, illustrating that inverse relationship clearly. Now let's look at the other side, the supply of money. Unlike demand, the supply of money is largely determined by the central bank of a country. They have specific tools, such as buying or selling government securities, to directly influence how much money is available in the economy. For the purpose of our graph, we usually illustrate the money supply curve as a straight vertical line. This signifies that the quantity of money supplied by the central bank doesn't immediately change based on fluctuations in the interest rate. Just like any other market, the money market finds its balance or equilibrium, where the demand for money meets the supply of money. At this intersection point, the market effectively determines the equilibrium interest rate, the price for borrowing or holding cash. If the central bank, for instance, decides to increase the money supply, this vertical line would shift to the right, leading to a new, lower equilibrium interest rate. Understanding these shifts helps us predict changes in borrowing costs and economic activity.
Thanks for watching. Consider subscribing if we helped you today.